Under pretty much any video or social media post we do, I get someone asking me if they should buy a house now. And I understand why you're hesitating. I mean, the fear, it's pretty obvious, given that everywhere we turn, we hear someone talking about the upcoming recession.
And that's scary because it means a recession is coming down the pike.
Then, on the next day, you see everyone speculating on the US debt default.
Default is a disaster.
Then the day after that, more and more media tell stories about the slowing economy.
The totality of data are telling us that we are slowing down.
And on top of that, we get so many contradicting opinions from different experts, social media, and the news. So in the end, it is no surprise that we have more questions than answers. Let's start with real estate. By 2030, the global real estate market will hit nearly $5.8 trillion. Nowadays, the US has the largest share of global real estate market. And in 2020 alone, the sector got over $1.5 trillion in revenue. Nevertheless, people today are in no hurry to sell and buy houses.
2023 could go down as the tightest inventory market conditions to have ever been recorded.
We saw the buyers pull back initially when the interest rates were much higher.
In the US, individual investors handle around 70% of rental properties. This is a great indicator showing that Americans love to invest in real estate. Yet, it gets harder and harder due to insufficient supply and growing prices. It happens largely because of the economic conditions, a greater number of investors and more people wanting to live their American dream. But the prices also increase because the homes are getting bigger. Imagine that from 1970 to 2017, the size of an American house grew by 73%. And on top of that, now people don't want to sell their homes to avoid losing low interest rates on their mortgage. If they sell, they will want to get a new place, but it will come at a new interest rate, which is now much higher compared to the near zero rates we saw during the pandemic times. That's why the number of houses for sale is down. Today, real estate investors face many issues related to property costs, yet it doesn't mean real estate has no opportunities left for its investor. So what's the reality of investing in this sector now with high mortgage rates, insane prices, and very few options on the market? Real estate was always less liquid than many other investments, especially now. Liquid investments are valuable because you can sell them fast if needed. Take stocks, bonds, gold, and silver as examples. You can easily convert them to cash. But what adds to the issue is that often those who invest in real estate are middle income group. And it isn't a bad move because it is a safe and reliable investment that compounds its value over time. Still, if a person needs money urgently, selling a house can be quite challenging, especially during downtimes. That is why it is so important to diversify your investment portfolio and allocate at least some money to the asset that you can quickly convert to cash. But again, this doesn't mean you have to stay away from real estate because even the richest people often start building their wealth with this type of investment.
We've both had a fair amount of experience in real estate, and Charlie made his early money in real estate.
And the best thing about housing is that even in times of economic turbulence, real estate investors still profit from rental income, property-related businesses, and value appreciation. Property values usually rise in the long run, allowing you to make gains when selling. When you're paying off a property mortgage, you also build more equity and increase your net worth. This helps you buy more properties or other assets thanks to its appreciation. Besides, when rents increase, property owners get more cash flow. And because people still need to live somewhere, this type of income really doesn't die.
So occupancies, rents, and they are as healthy as they've ever been.
Real estate is not only illiquid, but also has opaque pricing, meaning hidden pricing. Unlike stocks and bonds, real estate listings often differ from actual transaction rates because buyers struggle to determine the accurate buying price. And if we are facing time of crisis or a slower economy, it gets even worse. That's something we can observe now. After the record prices in 2022, the market is a bit lost as many investors don't understand what to expect from real estate in the face of a possible recession. Yet, at the same time, real estate serves as an inflation hedge due to its link between gross domestic product growth and demand. That's why, even though the inflation level now is one of the highest in decades, people are still looking into buying properties. Because investors understand that growing economies have a higher real estate demand, and the American economy will start to grow again sooner or later. This will eventually lead to higher rents and property values. So even though many keep saying that real estate isn't a good investment now, the facts show the opposite. The real estate value increases over time, providing potential appreciation. While serious crises like the 2008 housing crisis are uncommon and the market recovers anyways, still, some tactics that were loved by investors for years aren't really that effective anymore. What are those? Take house flipping, for example. House flipping got famous several years ago. In 2017, 5.7% of home sales were flipped, but this number increased by 40% in just 5 years. Despite its popularity, house flipping is less profitable today. In 2017, the average return on investment was 51% with a $65,000 profit. But by 2020, the flipping rates decreased in most American local markets. And this downtrend continues until today, which many say it's another proof of the housing market cooling down. So why doesn't house flipping work as it used to? First of all, house flipping costs got costly because anyone who has been looking to buy a house lately knows that affordable properties are scarce. That all happens due to high demand and limited supply. In pricier markets like New York City or California, flipping isn't just challenging, it's nearly impossible. The main reasons for that are high prices and market unpredictability. Besides, house flipping is risky because of its short-term nature. It involves purchasing properties quickly, renovating rapidly, and selling for profits within months. Success is uncertain because you might face unexpected costs, resulting in potential losses. Besides, house flipping isn't as easy as it might seem on renovation TV shows.
Flip was completed in 5 weeks and sold within 4 days of being on the market.
Something like this is so often so far from what investors face in real life. Quick renovations are usually demanding and costly. Besides, budgets and timelines often end up changing and postponing, even with experienced contractors. And unfortunately, no matter how good you are at DIY, those skills might not be enough or it will take way too much time. One more important factor flippers have to consider is buyers' preferences and market segments. If you want to resell your renovated house to high-end buyers, your cost-effective finishes might not work for them. And if you're focusing on entry-level homes with standard finishes, you might not make as much profit as you expect because people's budget for their first home are usually limited. So, as you see, house flipping is less popular and profitable today for numerous reasons. But many experts still say that it is a good time to invest in rental properties, especially residential ones, because the demand for rent is still high and doesn't seem to slow down anytime soon. But what if I told you that despite all those downsides, you can still buy a house with a mortgage and get passive income from it? The only difference is that you will buy real estate not to live there, but to rent it out. And that will be the very example of a good debt.
So real estate is, to me, the best vehicle, but you've got to be smart with it.
Did you know that more than 35% of households in the US rent homes? About 74% of all renters belong to Gen Zs. In general, the typical asking rent is about $2,062. The fast growth of rent costs since 2020 derives from various factors, including inflation, lack of inventory, and higher demand to live alone due to the pandemic. But still, the current asking rent is about 13% lower than the average monthly mortgage payment. That means many people are more likely to favor rented housing over their own.
I treat houses like hospitals. You know, you get in, you get out.
That's why you can use this tendency and rent out your home to get passive income from it. People want to live in certain areas, cities, or states more than others, and land is also limited. That's why houses appreciate over time. Of course, homeownership is rather a new concept, especially compared to gold. But through many crises, we see the same tendency. Real estate prices are not too volatile. While stock prices can drop in a day, the value of real estate isn't that reactive to economic turmoils. The first crucial aspect is affordability. Of course, I could tell you, go and get a house, but it is not something that is done without preparation, much less from one day to the next. Buying a house requires a down payment in most cases and at least some financial stability to ensure you can make your monthly payments. On the other hand, real estate can be also more affordable than you think. If you are eligible for down payment support programs and you work on the items that can lower your monthly payment, you can save on buying a house. We've seen the affordability aspect, but what's going on with the potential returns? On average, during the last 20 years, gold had a return of around 11%, but it might differ from year to year. In the same graph, we see that these are similar to the returns that real estate investment trust REITs provide annually. REITs are the companies that own or finance income-producing real estate and pay dividends to their investors. For those looking to learn more about REITs and invest in them, here is an episode for you to watch after you're done with this one. Now, if we take a look at investing in the property itself, the returns will be slightly lower. You see, residential properties have an average annual return of 10.6% and commercial properties of 9.5%. But of course, you can only expect these numbers if you hold your property for at least 10 years. In fact, both gold and real estate appreciate over time, but often when the economy is thriving, real estate tends to increase in value because a strong economy often means low unemployment rates, low inflation, and low interest rate. If you buy properties, you can rent them out and get a monthly income. Similarly, if you invest in the stock market, you get dividends. When you sell real estate, there is more to the equation than just selling the property. You need to work on finding a realtor, negotiating, maybe even making some repairs. You need to also wait until you find the right buyer, and so on. Any property requires ongoing expenses such as property taxes, insurance, and repairs. And these costs can impact the overall return on investment, the ROI. Now we're facing times of inflation. And as a result, the Fed raises interest rates to stabilize the economy. That's why fewer and fewer people want to invest in real estate and pay higher interest rates on their mortgage. So the demand for housing is decreasing.
So with real estate, how tangible is it? Very. Real estate is extremely tangible, very tangible. You can touch, feel, step on a house or a building. And the level of effort is actually quite high as well. Why? Because not only you need to, prepare yourself in terms of education, you also need to do your market research. You need to know where exactly you're investing. Not every single area is a nice area to invest just because you see a beautiful house, right? You also have to do planning in terms of your financing, right? How to qualify for a loan, and also planning in terms of your taxes. If you don't do this right, all the money that you're making is going to go away with the taxes that you're paying to Uncle Sam. So the effort, once again, is high. Now, regarding capital, do you need a high level of capital? Not exactly. Once again, it all comes down to education. So if you educate yourself, you will know that there are ways to invest in real estate with as little as $25. If you don't believe me, check out this episode on the side that's going to teach you how you can do that. On the other hand, if you don't educate yourself, you can take the long road and, spend a lot of money by giving down a high down payment or just simply by buying the wrong house for you that it's going to wind up costing you a lot of money. Now, in terms of income, well, real estate can generate a lot of income for you in terms of cash flow if you choose to rent it out, in terms of appreciation, which will help you look good in your net worth, and also with the depreciation, because it will help you save a lot of money on taxes. Huh? You didn't know that, huh? Now, in terms of usage or versatility, right? How versatile is real estate? Very, very versatile. Because once again, you can generate cash flow with it by either selling it or renting it. You can actually generate debt to create more money through a cash out refi or through a HELOC. And for those who are hearing about a cash out refi or a HELOC for the very first time, I invite you to check this episode on the site. After you're done with this one, of course, where I go very in deep about the subjects of cash out refis and HELOCs.
There are 8 essential steps to financially prepare for investing in real estate. First, if you're ready to buy a home, you need to work on your financial stability. Because when you want to borrow, you have to show the bank that you have a certain borrowing capacity. And how do you do that? First of all, you get your taxes in order. The bank will determine how much money they can lend you based on the income in your tax returns. Next, you need to figure out your budget and price range. This will help you focus your search to find the right home. You can do that by calculating the house you can afford based on income, expenses, debt, savings, and down payment. There are many online calculators that can give you an estimate, and knowing your range will help you set realistic expectations and goals for your home purchase. As a first-time home buyer, you might also want to look into some programs that can assist you in making a smaller down payment and getting favorable mortgage rates. Both federal and local governments offer these opportunities. They can provide you with grants, loans, tax credits, or discounts that can reduce the cost of buying a house. According to Bankrate, in 2022, 34% of home buyers were first-time home buyers. That's why there are many different programs that you can try to qualify for. And if you're looking for more information about these programs, here's a video where you can learn more about the subject, and make sure you check it out after you're done with this episode. Another important step is to estimate how much money you need for the down payment and closing costs. These are upfront costs that you have to pay when you're buying a house. You can define how much money you need based on the price of the house, the type of mortgage, the interest rate, the loan terms, and the fees and taxes involved. Then you can create a savings plan to help you reach your target amount within the shortest time frame. One of the best ways to increase your chances of getting approved for a mortgage and obtaining the lower interest rate is to improve your credit score as it reflects your credit history and behavior. You can work on your credit score by paying your bills and credit card balances on time, avoiding new debt applications prior to qualifying for a mortgage, and disputing any errors on your credit report. For more details on how to improve your credit, you can watch this episode after you're done with this one. Before you apply for a mortgage, you have to check your credit report for any errors or inconsistencies that might affect your credit score or mortgage application. Your credit report is a document that contains information about your credit accounts and activities. You can get a free copy from each of the 3 major credit bureaus, that is, Equifax, Experian, and TransUnion, at least once a year in annualcreditreport.com. If you find errors, you should dispute them with the credit bureau and the creditor involved as soon as possible. Another smart move is to shop around for rates and terms from different banks. This will help you find the best deal for your budget and financial situation. This will allow you to compare their offers based on their interest rates, fees, points, closing costs, loan types, loan terms, and other features. According to Rocket Mortgage, only 11% of home buyers from 23 to 31 and another 11% from 32 to 41 contacted a bank or mortgage lender as their first steps in their home buying process. This means that many buyers could be missing out on better deals by not shopping around. The last step is to get a pre-approval letter from a bank or mortgage lender. This will show realtors and sellers that you are serious and financially capable of buying a house. To get a pre-approval letter, you need to provide proof of your income, asset, debt, and credit score. Then you can use this letter as leverage when negotiating with realtors and sellers. It's just a matter of understanding what you are looking for, understanding what your current financial situation is, and what you can do to achieve your financial goals. And most importantly, don't be afraid of investing, because that's what can create wealth over time for you and your family. Start with something small, be consistent, and educate yourself to know what is best for you. And if you want to learn more about how to start investing smartly, check the video on the screen now. And I will see you in the next video. Bye-bye.